This is a continuation of Lesson 7 video. Bonds, what are they? A bond is an IOU certifying that you loaned money to a government or corporation and outlining the terms of repayment. How they work: buyer may purchase bond at a discount. The bond has a fixed interest rate for a fixed period of time. When the time is up, the bond is said to have matured. That means as much as it's going to, and the buyer may redeem the bond for the full face value. We don't see as many bonds purchased as we did at one time, probably. My parents purchased bonds in order for us to go to college, and that was how they saved their money. Some types of bonds are corporate, that are sold by private companies to raise money. If the company goes bankrupt, the bondholders have first claim to the assets before the stockholders, which is an advantage. Municipal are issued by any non-federal government. Municipal usually meaning city. The interest paid comes from taxes or from revenues from special projects. We hear about school bonds all the time. Earned interest is exempt from federal income tax, and that is how most schools are built, through these kinds of municipal bonds. The federal government, the safest investment you can make. My mother worked for the VA hospital as a nurse, and so she purchased bonds through the U.S. government. If the U.S. government goes bankrupt, it is obligated to repay those bonds. The next type of investment would be mutual fund. They are professionally managed portfolios made up of stocks, bonds, and other investments. Individuals can buy the shares, and fund uses money to purchase stocks, bonds, and other investments. Profits are returned to the shareholders monthly, quarterly, or semi-annually in the form of dividends. The advantages are that it allows small investors to take advantage of professional account management and diversification, normally only available to larger investors. So that's a good advantage. Some types of mutual funds: the balanced funds, which includes a variety of stocks and bonds. The global bond fund has corporate bonds of companies from around the world, meaning which is where the word global comes from. The global stock fund has stocks from companies in many parts of the world. The growth fund emphasizes companies that are expected to increase in value and also has a higher risk. The income fund features stocks and bonds with high dividends and interest. Industry fund invests in stocks of companies in a single industry, such as technology, healthcare, or banking. And the municipal bond fund features debt instruments of state and local governments. And the regional stock fund involves stocks of companies from one geographic region of the world, such as Asia or Latin America. So a lot of different types of mutual funds that you can choose from. Stocks represent corporate ownership. Stockholders own a share of the company and are entitled, by doing that, to a share of the profits, as well as to vote in the company and how it's run. The earnings are made, the company profits are divided among the shareholders in the form of dividends. These dividends are usually paid quarterly. Larger profits can be made through an increase in the value of the stock on the open market. Some advantages: if the market value goes up, the gain can be considerable and money is easily accessible. Some disadvantages: if market value goes down, the loss can be considerable. Selecting and managing stock often requires study and the help of a good brokerage firm. And those are some disadvantages. Another way to invest your money is through real estate. You can buy a house, live in it, and sell it later at a profit. You can buy income property that you're going to rent, such as an apartment house or a commercial building, or you can buy land and hold on into it until it rises in value. These used to be really good ways to invest, and in some areas they still are, but you have to be very careful when you're investing in real estate. Some advantages are that they're usually excellent protection against inflation. Some disadvantages can be that they're difficult to convert into cash, so you can't liquidate it real quickly if you need cash, and a specialized type of investment requiring study and knowledge of business. So you need to know a little bit about real estate before you try to do this. Capital gains are profits from the sale of a capital asset such as stocks, bonds, or real estate. These profits are tax deferred. You do not have to pay the tax on these profits until you sell the asset. Long-term capital gains occur on investments held more than 12 months, and short-term capital gains occur on investments held less than 12 months. So long-term more than 12 months and short-term less than 12 months. Retirement plans are another way to invest your money. They help individuals set aside money each month for retirement. Even though you may be paying into a retirement plan, it's not always enough, and so it's a good idea in order to keep up with inflation and to have a good retirement to add to that each month. Federal income tax not immediately due on this money that you've taken out of your check each month to add to your retirement. Income tax paid when money is withdrawn, which penalty charges apply if the money is withdrawn before retirement age, usually in most cases before the age of 59. The retirement income is lower, so your tax rate is lower when you get ready to withdraw. There are IRAs, which allows a person to contribute up to $3,000 of pre-tax earnings per year. Contributions can be made in installments or in a lump sum. The Roth IRA, also sometimes called the IRA Plus, it's $3,000 annual contribution, but it's not tax deductible. The earnings on the account are tax-free after 5 years. The funds from the Roth IRA may be withdrawn after age of 59 if the account owner is disabled, for educational expenses, or for the purchase of a first home. So they are not a tax deductible item. The 401k allows a person to contribute to a savings plan from his or her pre-tax earnings, reducing the amount of tax that has to be paid. Employer matches contributions up to a certain level in a 401k. And a KEO plan allows a self-employed person to set aside up to 15% of their income, but not more than $35,000 per year, which is another type of retirement plan. More about IRAs. Contributions made only between ages of 22 to 30. If you made a $2,000 contribution for 9 years, you'd get a total investment of $18,000 at an interest rate of 9%. By the time you were 65, you would have $579,471 in the bank, which is almost half or more than $500,000. If you waited to contribute from the ages of 31 to 65 for 35 years, a $2,000 contributed each year, total investment of $70,000 at an interest rate of 9%. By age 65, you would only have $470,249. So this is to say that the younger you contribute, the better off you are. To avoid investment fraud, each year, billions of dollars are lost to fraud investments. Some of the most common include illegal pyramids, insider trading, and unlicensed investment brokers, high-risk penny stocks and fraudulent securities, fraudulent franchise and business opportunities, internet services, 900 numbers, and the list goes on. So you want to be sure that you are investing in a legitimate investment. To protect yourself from becoming a victim of investment fraud, you want to Become informed about investments and industries before you invest. If you're aware that there is some fraud in this, it is very helpful to know that. Talk with others who have made similar investments. Obtain information from state and federal regulatory agencies. Never buy over the phone. Avoid investment opportunities promising large returns in a short amount of time. And again, that too soon to be or too good to be true, because they probably are. And you can get more information from fraud.org or ftc.gov about avoiding investment fraud. So be sure you are investing your money in a legitimate place by doing your research. End of this video.